Okay, everyone, can you hear me? Yes, fantastic. Really good to see you. Thank you so much for coming. My name is Ben Caldecott. I'm the director and the PI for the Centre for Greening Finance and Investment. Welcome to our first annual forum. Great to see lots of people here, convening together in person. It's been over a year since CGFI began operations. We began operations in April of last year. This is our first annual forum. We were planning to do this last year, but couldn't for obvious reasons. So we're really happy to bring people together finally in this way for today's conference. Now, we plan to have host these every year, and for them to be a really key moment for the UK finance-focused climate and environmental analytics community, where we can come together, where we can learn from each other, and also catalyse collaborations across different bits of the system. And by that I mean academic researchers, I mean finance sector end users, I mean obviously data and analytics providers, regulators, policymakers, and also civil society. We have representatives from all of those groups here today. And in this forum, this year's forum, we'll be examining the role of data and analytics for areas including net zero transition plans, an area that we're doing a lot of work in, climate resilience, another area where we're doing a lot of work in, and the integration of nature-related factors into financial decision-making, an area where we're starting to do more work. We'll also be showcasing successful applicants from the recent Innovate UK funding competition, focused on piloting innovative solutions that integrate climate and environmental factors into financial services, and some of you will be representing organisations that have been successful in the first phase of that funding and are thinking about the next phase, the bigger pot of money that will be coming. Now, we're at CGFI, we're supporting the holders of these Innovate UK grants to deliver these next generation solutions, and you'll have the opportunity to engage with them, connect with those applicants, those successful applicants, and input into the development of their services and the things that they are developing. Now, CGFI is still very new. Some of you may not be that familiar with who we are and what we're trying to do. By the end of today, you should have a much better sense of the work that's going on across the consortium, who's who within the consortium. You'll hear directly from many of my colleagues and hear about their work firsthand. But what I wanted to do in this brief period at the beginning is to outline, say a bit about CGFI, introduce it to you, particularly to those of you who are new to us. I also wanted to provide a quick update on the work we're doing, particularly on our platform, and also our role in supporting the innovation ecosystem in the UK. So that's what I'm going to do. What are we trying to do? Essentially, we've been set up to bring climate and environmental science into financial decision-making globally. And I think one way of thinking about this is, there's been tens of billions of dollars invested in climate and environmental science around the world, a lot of that happening in the UK, but obviously happening all over the place. And that ranges from investments in climate models through to Earth observation platforms, to scientists creating observational data sets, theorizing about different aspects of Earth systems. And some proportion of that, we think, is going to be relevant for financial decision-making, particularly in light of climate change, these broader environmental challenges. So how can we increase the amount of that gets into financial decision-making, and how can we make sure that more of it is used appropriately? And I think many of you would agree that not enough of that is happening. So we've been set up to try and address that, and addressing that, I think, is a necessary condition for getting capital to flow, for realigning our economic and financial systems to tackle climate change, to tackle these other environmental challenges. So the data and analytics question, making sure that data and analytics is fit for purpose, is at the heart of what we're trying to do in CGFI. And as you'll see, it's a very science-led enterprise, given the consortium members involved and the world-leading academics involved. And what we hope to be able to do, and this is quite an ambitious task, is to enable financial institutions around the world to access climate and environmental data for any point on the planet, to get historical data, to get data that is current, in some cases real-time, near real-time, and also projections well into the future. And for this to be useful for assessing environmental risks and externalities for every major sector of the global economy and for all the different material climate and environmental factors. And as I say, that will enable us to reallocate capital. That will also improve the resilience of individual financial institutions and the financial system as a whole. And as you'll see, there's a theme running through this as well, in particular in terms of one of the reasons we've been supported by, created by the UK and by UKRI, is that there's an opportunity here for the UK commercially, that this is potentially a very exciting commercial opportunity for a variety of reasons that I'm sure we'll talk about at various points today. A couple of other quick points. So although we are a UK established centre, our scope is global, and we're working with global financial institutions, and we are seeking to engage with and work with and influence institutions around the world. We are also working very closely, collaboratively with our sister institution, the Green Finance Institute. So another way of thinking about this is we're focused on greening the financial system. They're focused on how we get capital to flow into solutions to climate and to solutions to these issues. And this has not been something that was set up incredibly rapidly and without lots of thought. This has a long history, actually. I was talking to Jonathan Gascoigne, who's I think in the room, reminiscing. Maybe reminiscing is not the right way to put it, but reflecting back on the Green Finance Task Force and the Green Finance Strategy, and the fact that some of the people here today, John, but also Rowan Douglas, who might be in the room or will be later, and Ian Sim, and others, were making the case for a national centre to do what we're doing back in 2017-18, and it's taken quite a while to get us going, but thank you for that. And then I think looking ahead, we were established through the Green Finance Strategy 1.0 that came out in 2019, and obviously the government's now thinking about a Green Finance Strategy 2.0 that will hopefully come out before COP27. So one question for us here, and we'll talk about that in the first panel, is what next, and particularly what else should we be doing to integrate climate and environmental data and analytics into financial decision making? So the consortium, we built this consortium to scale, to do more. We have colleagues from a number of different institutions, so let me go through them quickly. At Imperial College, we have the Centre for Climate Finance and Investment, as well as the Grantham Research Institute. At the University of Leeds, we have the Priestley Centre, as well as Leeds Business School. At the University of Reading, there is their Institute for Environmental Analytics, and also colleagues who work at the National Centre for Atmospheric Science at the University of Reading. At Bristol, we have world-leading hydrologists who are part of the consortium led by Paul Bates. We also have the team behind Daphne and Jasmine, which are a key part of our digital infrastructure at the Science and Technology Facility, the STFC Science and Technology Facilities Council. We also have the Alan Turing Institute, which is our national laboratory for data science and artificial intelligence. At Oxford, there are three bits of Oxford that are part of the consortium. The Smith School of Enterprise and the Environment, and my group there. The Environmental Change Institute, that many of you will have heard of and collaborated with, and also our Department of Engineering. So lots of different capabilities across that consortium across the UK. And then we're working with a whole range of different partners across the UK system, from professional bodies to regulators and other science centres. In terms of how we've been established in terms of the UKRI contribution, we have 4 years of funding from NERC, and you'll hear from Sir Duncan Wingham of NERC shortly, and that's to sort of set up the centre, set up the infrastructure, the science capabilities and the translation activities. And there's also funding from Innovate UK, and the vast majority of that funding is going directly into innovations in the sector. Again, you'll hear more about that. We've also, in I guess UK style, I suppose, there's a lot of focus on co-funding and leveraging public funding, and so we have other funders that are supporting projects across the consortium. So some, but not all of them I can mention here. So for example, we have a partnership with Bank of America, ones that are going to be properly announced soon with Barclays and Willis Towers Watson, or WTW, the Insurance Development Forum, the World Bank, the EPSRC, all fund different aspects of our work. So we are securing co-funding across the consortium to scale up our work and to deliver value for money to the taxpayer. You'll hear throughout today a big emphasis on flagships. These are flagship projects that we've set up over the last year, different stages of development. But we've got these 5 ones. One's focused on property and extreme weather events. Another one's focused on litigation and environmental damages. We have one focused on infrastructure, supply chains, and related systems, and we have one focused on transition risk. And we also have a kind of cross-cutting one, which is focused on supporting disclosures through mandatory or voluntary, depending on where you are in the world, TCFD and TNFD disclosures. So those are led by different co-investigators across the consortium. They involve partners in different ways. And what we're trying to do through each of these, and the outputs of all of these flagships are going to be open, or are open already, but the point is that we have these to focus in to really understand user requirements in these specific areas. We want to develop tailored solutions to those end users. We want to show how the capabilities we're developing in partnership with financial institutions are having impact and actually useful, because that is a way of building demand for the changes that we need to see in the system. And through each of these things, we're drawing out products, learnings, good practice that we're then sharing more widely, including with some of those companies, innovators that are coming in and seeking to improve and enhance the capabilities for the system as a whole. Now, the flagships speak to multiple use cases. So although, for example, we might be doing a lot of work on property and weather extremes with banks, those data sets, those projections, those analytics are going to be useful for other use cases. And you can see some of these here. In each of our flagships, and pretty much in all of our projects, we are taking this approach, which is to start with good foundational asset level data by sector. And this is, I think, critical for much more sophisticated approaches to analysing risks and externalities. We're then creating common, accessible, open hazard layers and projections, and then we're developing these use cases. So this is sort of a common approach across the different flagships that we have in the consortium. Now, one of the things we have committed to do as part of CGFI is to create a platform, and we want to make sure this is an open, easy-to-use information e-infrastructure. We want practitioners to be able to access this, build off and integrate climate and environmental data and analytics. And we're going to be using this to share the data and analytics we create through CGFI projects, including the flagships, but also where it's useful for the wider community, we will be able to curate data and information from other parties, including those we have close partnerships with, but not exclusively. So what we're trying to do through the platform, but also our wider work, we want to make sure new foundational data sets, including asset level data sets and metrics and other models, are available, are transparently available, that they're not a series of black boxes, that people can interrogate those data sets. We want to create this bridge between financial institutions and world-leading scientific expertise. And how can we make all of that existing work relevant, but also how can we make sure that the questions scientists are looking at now and into the future can be made more relevant. We want to fill gaps that exist and understand where gaps exist, so further work can be done. And we also want to improve the accuracy and confidence levels, or particularly the confidence levels, I think, with existing data sets. So when you're using projections for different things, how accurate is that data? What are the confidence levels associated with it? And there's work that we're doing there. With the platform, you can see here we are not trying to host all data that exists. That isn't what we're trying to do. We're going to be hosting and making accessible the analytics and the data that we generate. We'll also be creating a smart catalog where we're curating data from different projects, from different partners as well. So we're sort of sitting in between just hosting our own information, our own data, versus hosting everyone else's. And we're keen to work with other platforms that exist. There are a number of different efforts underway to try and make sure that data is brought together in a way that's useful for financial institutions. This is just to emphasize the fact that we're working very, very closely with the STFC and Daphne and Jasmine for those in the room who follow those things. Now, in terms of the data sets that are going to be on the platform, I mentioned asset level data, so we have iron and steel data sets, global asset level data sets for those sectors already online. We'll be adding cement soon, I think, this year. The Global Resilience Index Initiative, which you'll definitely hear about later, we are in the process of adding hazard and exposure layers. On models, we are hosting Climate Financial Risk Forum scenario tools and a narrative tool. It's already online, you can see that. And then a infrastructure systems tool focused on Jamaica and Southeast Asia, and other things that are being prepared for COP27 that you can see here. And then we have this emerging pipeline. And obviously this is going to be shaped by the work that we're doing across the consortium, the work we're doing through the flagships, and also the conversations we have with partners. So I just wanted to mention all of this in part to plant the seed. If you think that this would be a useful vehicle to share, a useful distribution channel for data sets, models, and so on, then please do reach out to us, and we want to make it as useful as possible for the wider community. Just to hear a bit more details. You'll get the slides later. You can see the production timeline for these open asset level data sets. And in addition to the sectors I mentioned before, cement, iron, and steel, and aluminium, and cement, we're also doing aluminium, chemicals, particularly petrochemicals, pulp and paper, waste management, first instance landfill sites, and wastewater treatment as well. This is the Climate Financial Risk Forum partnership, and this is the physical risk pilot for Southeast Asia. And this is something that was announced. This is the GRI, the Global Resilience Index Initiative I mentioned before, that was announced at COP26. Now, in terms of supporting innovation, we want to nurture, to stimulate this ecosystem, an ecosystem that you're all part of. And so all the things that we do, we want them to be a foundation for you to use to build capabilities on top of. And we're working to develop a range of activities also to nurture the ecosystem. So we'll soon be announcing a range of different events and convening to bring bits of the community together in different ways, in-person, virtual, across the country, and providing knowledge exchange, and also starting to provide some methodological feedback to make sure that best practice in terms of how data is being used gets introduced into the development of products early on. And all of this is happening side by side with the Innovate UK call, and those innovation activities will be accessible to the winners of that Innovate UK call, but also to others. So if you didn't get an application in on time for the Innovate UK call, or you unfortunately didn't get in for whatever reason, we want to be there to support you as well. And a lot of that support will be centred on two hubs, one led by Imperial in London, and the other led by the University of Leeds Business School in Leeds. And Ian Clacker at the back is running the Leeds one, and Martin Siegert, who is at Imperial, isn't here today because he's got, I think, COVID, but he's running the London one, and Christoph, who you will meet at some point, is playing a key role in both of them. Now, you might be going, what the hell is this guy doing up on the screen? So what I wanted to do was just address the issues that we're seeing in the wider sustainable finance space head on. I think there are a number of things. So the Stuart Kirk example is one. You have DWS and the greenwashing claims, and BaFin and SEC and and raids their offices, SEC charging BNY Mellon allegedly for business, well, charging them with alleged misstatements and omissions, Goldman Sachs allegedly being investigated as well, and ESG stocks tanking, in large part because they're jam-packed full of IT companies, right? And then underperformance. So those are some challenges, and I think that is shining light. There's no point ignoring these things. We should engage with them. It's shining light on the way in which ESG ratings, in particular, have been created and used so far, particularly in the investment management industry. But it throws up questions about how these are being used across the system. So the first thing to say, of course, is that ESG ratings do not equal the sum of sustainable finance and investment. And so we mustn't get into this situation where we're conflating these two things. So if you ever have the opportunity to clarify that with anyone, please do. I think this is the result of greater sophistication, growing maturity from market participants, but also clients, but also critically regulators. So a lot of the things that we've just seen were regulatory interventions, not from the UK, but from the SEC and from the BaFin. Expect more of that. And I think what that will mean is that it will spur more interest in demand for the sorts of things I was just talking about, and the sorts of things that we'll talk about today, right? Which is really grounded, bottom-up approaches, a focus on robust measurement. What are we measuring? What's the best approach for measuring that? Is it robust, transparent, and so on? And of course, a greater focus on being able to substantiate claims that financial institutions are making. So I see this as a great big opportunity to improve practice, and there's more than a little truth in some of the criticisms around ESG ratings. And I think this community, particularly in the UK, has this really important role, I think, and can be a driver of greater integrity and robustness at a critical time. So I think just reflect on that. Yes, it's a bit of a challenge. It's a bit of a different environment in terms of there being more criticism, but it's an opportunity that we've got to grasp. And I'm looking forward to talking about these and related issues with you today. So enough from me. We're going to hear now from a minister, John Glenn, Economic Secretary to the Treasury, who couldn't be here in person, but has a video message for us. So cue John.
Hello everyone, and I'm very sorry that I can't be with you in person, but I'm very thrilled to open the very first CGFI annual forum, focusing on innovation in data and analytics to advance green finance. Today's forum comes at a crucial time for two reasons. Firstly, at COP26 in Glasgow last year, thousands of financial institutions and corporates made a whole range of net zero and nature positive commitments, ranging across advanced and emerging economies. But as we move towards COP27, we must collectively demonstrate the credibility of those commitments. And secondly, green finance policy is developing quickly and requires your engagement. Later this year, the government will publish an update to the 2019 Green Finance Strategy. The updated strategy will take stock of progress so far and set out how the UK can better ensure the financial services industry is supporting the UK's energy security, climate and environmental objectives. And our call for evidence on the strategy closed recently. At COP26, we set out plans to become the world's first net zero aligned financial centre. And this included the launch of the Transition Plan Task Force, which I chair, with the CEO of Aviva, Amanda Block, to develop a gold standard for transition plans in the UK and inform future regulatory processes. And this task force is partly supported by CGFI and is quickly developing a sector-neutral framework for transition plans and associated guidance. High quality and accessible data are the bedrock of a successful transition to a net zero future. inadequate access to data is a major barrier. So addressing this was a key recommendation of the Green Finance Task Force and the reason for the establishment of the CGFI last year. So I'm greatly encouraged by the progress that CGFI has made to address these issues and excited by the discussions today, which will identify the priorities and opportunities for the next generation of climate and environmental analytics solutions. And I'm also really excited by today's showcasing of innovative solutions from startups and SMEs, which have been awarded funding by Innovate UK to develop the next generation of green finance analytics. The UK is not only a global leader in innovation and green finance, but also generates world-leading climate and environmental science, analytics and data sets from across the public and private sector. So bringing these different ecosystems and skill sets together is essential if we're to deliver on our green finance ambitions. And there's no better place to do it than here in the UK. So I'm certain that collaboration between financial institutions, data providers, and the scientific community is crucial to underpinning a successful transition. Today's forum, with all your experience and expertise, represents the frontier of this movement. So thank you and good luck.
Hello, I'm Duncan Wingham. I'm the chair of the Natural Environmental Research Council, and it's a pleasure to be offered the opportunity to appear, at least before you today, and offer you a few words to encourage, as it were, your first annual forum. In some ways, at least, I could fairly be said to say I'm the reason you're all here, in as much as the activity that you are now all centrally involved in had its origin in conversations that I had back in 2018, which themselves are largely inspired actually by the comments that Mark Charney, the then director of the Bank of England, was making about the need for the business sector generally to start to put on its balance sheets the risks that the business was running as a result of climate. There were also wider conversations at that time going on about how finance itself needed to become more aware of the implications of its investments. What impact were they having on the environment? What effect were they having on encouraging or reducing climate change? And what did businesses have to do in order to minimize their impacts on the environment, but also to minimize the impact the environment was having on them and the risks that they were running as a consequence of the environment? We decided then at that time actually that this was a space that NERC ought to occupy. It's clear that environmental science is one of the jewels in the UK's scientific crown, and not only understanding of the environment, but also the very substantial data that over many years we've collected to learn about the impacts we're having on the environment. So this was in a way a natural space for NERC to seek to occupy and for NERC to issue funding call. However, it was also obvious that success needed not simply scientists to work on they need. We needed a mechanism for bringing science and research together with the finance and business community. And for that, we needed to be able to fund the finance and business community directly. We were fortunate at that time in just being part of the newly formed UKRI. And what that enabled us to do was to think about novel instruments, about new ways of funding research and innovation activity by bringing together the funding of the research councils with the funding of Innovate UK. And this activity that you're now involved in is very much is the first experiment that we've run in many ways in bringing together these two pieces of funding by creating a competition that first aimed to establish the scientific and research part of the activity. And then having done that, we could then bring in the Innovate funding to attract in businesses and those from the business side who would understand what needed to be done from that perspective. The competition was quite fierce, actually. There was a lot of bids, and so you ought to be pleased with yourselves without, I can say that without hesitation, about winning it. So my congratulations to Ben Caldecott and at Oxford, but also, of course, your partners, so Reading, Bristol, Imperial College and Leeds. And that list, of course, is a substantial cross-section of the expertise of environmental science in the UK, which is needed to face up to the challenges of understanding how we transfer that knowledge into the business sector. So my congratulations to you for winning the competition, but also maybe a challenge for you. You are an experiment. What we are hoping is a successful experiment in bringing, as I say, together research and innovation funding to try and produce a new kind of impact and a new kind of outcome. It's also the case very often at occasions like this, people hope I might make some remarks about the future of funding. I must say that it's very difficult to see clearly everything that happens places ever greater importance on our understanding, broadly speaking, our impact on the environment. But I think what is also becoming really clear, and this was undoubtedly a theme at COP, is that if we are to be successful in reaching equilibrium with our environment, it will be the private sector that delivers that. And so understanding how we make the best of the research that we've been pursuing over the last 50 years, and how we make the best of the data that we've accumulated on the environment over that period of time in order to produce advice that business can use and thread through its decision making and thread through its assessment of risk. It is a very important thing, and something that we are only going to encourage. The initial focus of much of this activity, and certainly Mark Charney's focus, was on climate. We not only does business activity have an obvious impact on climate, it's all obviously impacted by it. But the challenge of understanding what the impact on the environment and what the impact of the environment on business is much wider than just climate. It certainly includes biodiversity, but if one also looks a bit more widely, a wide range of impacts, such as, for example, those of agricultural fertilizers on rivers and the ocean. So there is a great deal to do. You are leaders. You're the initiation of what I imagine will be a growing activity in the years ahead. So let me wish you a lot of luck with your forum, but also wish you a lot of luck in building a new event, new groups, new collaborations to take forwards this entire task of understanding how we embrace green finance. With that, I hope you have a great forum. I hope you enjoy yourselves, and I look forward in due course to hearing about the outcome of your activity. Thank you very much.
Great. Well, two very nice little speeches there. So I just wanted to quickly run through the agenda for today to just make sure we're all on the same page, and actually maybe the first panel could start moving up onto the stage. So the first panel will be on the Green Finance Strategy 2.0, and Sophie has very kindly agreed to chair this, and we have some wonderful speakers who will introduce themselves shortly. We'll then have a coffee break. That will be in the Great Hall, where you were having coffee earlier. We'll then come back for another plenary session that's going to be focused on credible net zero transition plans. And as the Minister mentioned, we're co-leading the Secretariat for the high-level transition plan task force that's been created by HMT. And some of the members of that task force will be joining us for the session. We'll then have lunch. hour and 15 minutes or so. We want to make sure there's lots of time for networking. We're then going to hear from Emma Howard-Boyd, who's going to give us a keynote, some of which has been trailed today in the press. You might have heard her on the Today programme this morning. We'll then so after that, we're then going to have some parallel sessions. So the first parallel session will be here, and that will be on advancing nature finance. Downstairs, in parallel to that, will be innovation pitches from the from the Innovate UK competition winners, stage 1 winners, and that's going to be in the Godfrey Mitchell Theatre. We'll then have another coffee break. We'll then have 2 other parallel sessions. In here, we'll be focused on financing a resilient transition, and then again downstairs will be further Innovate UK pitches, and you can see some of the pitch themes and the documentation associated with them on your agenda. There should be links that work. Now, just a couple of administrative things. So firstly, we won't be coming back here after the afternoon parallel sessions. We will go straight to networking drinks. You'll be glad to know. The other thing to say is that all the sessions in here will be recorded and will be put online later in the week. All the sessions, the pitches downstairs, will not be recorded, and that's partly because we want to respect confidentiality and things, and people are talking about relatively, in some cases, quite nascent ideas, so we didn't want to record those. So without further ado, over to Sophie in the first panel. Thank you.
Thank you very much, Ben. For those of you who had the original agenda, you might be bitterly disappointed to see that I'm not Ben, but my name is Sophie Robinson-Tillett, and I work with Ben a bit at Oxford at the Third Sector Academy, and I'm also a sustainable finance journalist, so some of you may know me from that. I'm very excited, though, to say that nobody else on the panel has changed except one new addition, so that's the most important thing. We have this glorious panel to kick us off for the morning's discussions. So without further ado, let me introduce them. I think we've got Adam Lyons, Head of the Green Finance Unit at the UK Treasury, David Harris, Global Head of Sustainable Finance Data and Analytics at the London Stock Exchange Group, Dr. Nicola Ranger, Director of Climate and Environmental Analytics at the UK Centre for Greening Finance and Investment, and at Oxford Sustainable Finance Group with Ben. Ian Sim, Founder and CEO of Impacts Asset Management, which is a well-known green finance house, and Chris Faint, Head of Climate at the Bank of England. So thank you very much all for joining us this morning to help kick off these discussions, and they are quite big discussions. We are going to try and conquer in the next hour green finance strategies, both the original one that was mentioned earlier and the upcoming sequel. So, you know, most of you will probably know, but 2019 UK government launches the Green Finance Strategy, and it paved the way for lots of the initiatives and announcements that we've seen since, particularly in the run-up to COP26. And we'll talk about what they were and have been, I'm sure, in more detail, but they focus largely on disclosures and standards and those kind of things. They've mirrored similar efforts around the world in this kind of regulatory way. It's worth noting that there has been some criticism, if I'm allowed to call it that, that the focus has been on data and disclosure, and that we need to move over to what Ben talked about earlier as financial decision making. So it'd be really interesting to hear what might be coming up in the strategy or the thinking around moving from that transparency to actually changes in the real economy. So the second strategy is coming up before COP27, we hope. It's obviously going to be a very different conversation as well, because we've had COP26, we've had GFANZ, as we heard earlier, sort of the official buy-in from the financial markets on this. So we're in a slightly different place than we were in 2019. We're also in a pretty different place economically and in terms of the conversation around energy. So I think that those things will probably be factors in what this sequel needs to look like. But there's a lot of things to get through. Maybe we can, Adam, can I start with you? You were very involved in the strategy part one. So do you want to offer some reflections on what went well and what maybe didn't in the first strategy? I know you probably maybe can't talk so much about what's coming up, but what's happened so far?
Sure. So, hi everyone. I'm Adam. As Sophie says, I'm head of green finance in the Treasury. Sorry to disappoint you. I actually was not involved in the first green finance strategy, but I am very involved now in work on green finance. So, I mean, just some reflections on I think where we've got to, and some of I think where we've got to on particularly the greening finance side was set out in our document that we published last year, which is called Greening Finance, A Roadmap to Sustainable Investing. And I think that talks to some of the points you mentioned, specifically that we see the pathway to greening the financial system in 3 phases, which we called Inform, Act and Shift. So Inform is really that first phase that you talked about. That's really how do you get the ESG data ecosystem working? How do you make sure that every financial decision has the data it needs to take climate, the environment and sustainability into account? But we also see 2 further phases. So the second is Act. Clearly, once that information exists, it's really important that it's then acted on in financial markets. And then the third phase is Shift. So over time, we'd like to see a shift in financial flows to align with net zero. So that's the model we're working to. And then to deliver that, and specifically focused on that first phase, we are implementing sustainability disclosure requirements. So this is an economy-wide disclosure requirement regime, which will see real economy corporates, financial services firms, investment products, all disclosing consistent, comparable, decision-useful information on sustainability. So there's a few different elements of that. There's the UK Green Taxonomy, which will create an objective definition of what's green. There's the international standards. We're very clear that in the UK, we want almost everything we do on green finance to be aligned where possible with international standards. So we've made a commitment to consider adopting the standards being produced by the IFRS, the ISSB. And then there's also the work on transition plans. So how do you embed transition planning into a normal part of doing business in the UK? So that's the sustainability disclosure requirements. You also talked about the forthcoming green finance strategy. I think it's there that we really want to focus on the next 2 phases. So how can we make sure that information is acted on, and how can we, over time, shift financial flows? So I can talk a bit more about that later, but I think I'll stop there for now.
Chris, can I come to you? Your reflections on how things, I know that the Bank of England's been doing a lot on stress testing and scenario analysis and the kind of other piece of this puzzle. Do you want to talk a little bit about your role and reflections so far?
Yeah, with pleasure. So the Bank of England, we've been looking at the risks that arise from climate change for about 6 years now, and I think the body of our work has just got bigger and bigger and bigger in this space. So we're very firmly in the greening finance side of the green finance strategy equation. But of course, we can only help to shine a light and help the economy to manage risk if the financing green side is in place. And because of that, whilst we are focused on risk, we're also interested in everything else that's going on in this space. And we hope that some of the things that we are doing at the Bank of England can also shine a light on areas that are of interest to others. So that's where our climate scenario analysis comes in, which I can talk to it for about an hour. I've done presentations, very boring presentations for an hour, but I will give you just a couple of highlights, I think, from that exercise that demonstrates just how important the work that we're talking about is today, because I think it is quite pertinent. So one of the findings that we found from this scenario exercise, where we asked the largest banks and the insurers in the UK to undertake 3 scenarios spreading 30 years into the future, one with an automatic transition, one with a delayed transition, and one with no transition. One of the things that we found was that when banks came back, when they had shared counterparty, the same counterparty as each other, and they modelled impairments in one of our scenarios, the impairments were 10 times larger in one bank than in another. And what that reflects is that different institutions, in the absence of data, are making judgments about how their counterparties will act. So they're making judgments about their supply chain and about their activities. And those judgments are hugely different. So it shows that there's just a real need for data, a need for understanding, a need to understand those transition plans in those firms to get a clearer view on what's going to happen over time. And actually, when we looked at the way that risks would arise in the economy, you might think that the greatest impairment, the greatest losses would come through sort of households and retrofitting and companies. Actually, that wasn't the case. The greatest losses that we saw came through life insurers and the investments that they held. So there was a 15% reduction in those investments, and in reality, it could be somewhat higher. So it's showing that climate change will have huge market impacts, and at the moment, there's not very much information for us to understand how those are going to hit. So I think this is another indication that there is a huge demand for understanding of what's going to happen to firms, what's going to happen to the investments that are associated with those firms over time, and what does that mean for the financial institutions that hold those investments. And then just to bring out one more, we found that certain industries would see significantly greater impairments than others, and these industries are not surprising. So those that were in manufacturing, those that were in oil and gas, in those industries, impairments were 50%, just under 50% higher in some of the scenarios. So their loans would be expected not to be paid back, and there'd be other write-offs. So what this demonstrates to us is that there's going to be a huge movement in the expectations of those businesses, and there's going to be a huge movement in the amount of lending that goes to those businesses. So with our financial stability hat on, what we're interested in is, as we transition to net zero, how can we make sure that the investments are going to the right industries at the right speeds to ensure that you're transitioning the whole of the economy and not just the greenest parts of the economy, which is a really tricky thing, but that talks to the other tools that are being developed, such as taxonomies and increased disclosure. As I said, I could talk about this for a long time, but I will leave it there, but I think we'll probably come back to it.
I'm sure that we will.
Thanks.
Thank you very much. David, this is not your first rodeo, is it? You were heavily involved in the EU's HLEG, high-level expert group, who did a similar process to this at EU level, which we are reading much about in the headlines over the last 18 months. But you've been kind of part of this process for a lot longer, and also doing climate data since before it was cool, I think it's fair to say. He was that guy at the COP that says once upon a time. So you've been watching this for a long time. What Chris said, a real need for data. Presumably you agree, but what are your reflections on where it fits, where we've come, and what lessons we've kind of learnt so far on this?
Cool. Well, thanks, Sophie. It's great to be here. And I think there is this kind of bit of a moment of reflection going on now, where we have just seen this incredible kind of almost fever pitch around sustainability and climate investing, and Ben kind of mentioned some of that earlier. And certainly for us, this is, I should also maybe explain the organisation. So my organisation, CGFI, for the last few years, the London Stock Exchange Group came together with Refinitiv, the Thomson Reuters financial data business, last year. So we've got very large data analytics indexes, as well as the exchange business and as well as post-trade. And sustainability is kind of relevant across all of that. And what we're seeing is really across every client type, this is now becoming kind of top of the agenda. So, and not just in kind of the talking shop, but actually shifting capital. So take the index business, which I've spent much of my career in. This is now the main reason why the biggest pension funds and asset owners in the world are switching benchmarks, is because they're wanting to incorporate climate into that. So this is kind of, there is this incredible shift starting to take place. But at the same time, we have got some pretty big issues to try and deal with. Firstly, clearly, the climate is still going very much in the wrong direction. We've got higher emissions each year. So these shifts that are going on within the financial sector and with the business sector, are still nowhere, are not achieving what they need to achieve by a long chalk. But equally, just in terms of the data itself, the underpinnings of this, are not as strong as they should be. So we talked about the need for action, but it's action, and the disclosure agenda isn't over. We need to still continue to improve this. So if you take some of the most basic ESG climate data, Scope 1 and Scope 2 emissions data, globally, large and mid-cap companies, largest 4,000, about 40% of those companies don't disclose that data at all today. If you look at Chinese companies, Chinese A-share companies, and similar large and mid-caps, you'd be looking at less than 10%, so 90% not providing that data. If you go to US small caps, the Russell 2000, it's the same, 90% not disclosing information at all. You've then got, and this is one of the big underpinnings for a lot of these data models. And so firms like us are then kind of calculating missing data. So we've got estimation models in how to do that. But the problem is there's no scientific consensus around what's the best way of doing that. There's no industry consensus. There's a variety of models. We produced a paper just about a month ago on called Minding the Gaps, Bringing Clarity to Corporate Carbon Emissions. And we looked at kind of the 4 different main models on how to estimate missing data. I won't take you through the full details across all 4. But the difference, they were typically, because you were able to test it against the companies which actually had reported to then see if you were estimating it, how close would you be? Over half of them were 100% out. A quarter of them were 200% out. So and I should say, none of the models were necessarily that much better than any of the others at their estimation power. So, so even on this kind of corporate reported data, we've got big challenges. I should say, so that's one kind of big issue. And another is that interconnected with that is that the regulatory and policy agenda, we're seeing obviously lots of ambition, lots of movement, which is fantastic. But they're often not joined up. So we see this as an international level, 3 major consultations going on at the moment. We've got EFRAG, we've got the SEC, and we've got the International Sustainability Standards Board, all consulting at the moment actually on these related issues on climate disclosure and sustainability disclosure, but they're actually all different. There's some commonalities, but they're not the same. And we've got to get this together. There's also across different, even within the same regulator, certainly in the EU. I was involved at the beginning with the high-level expert group, and I think our recommendations were good, but the implementation of it has been, kind of interesting, where you've got basically different sets of regulations for those in the financial sector versus the corporate sector. So you haven't got that data flow to move through. You're asking asset managers to report on data that just doesn't exist and no companies are reporting, and that isn't collectible by satellite or asset level data either. So so you've got there's a need to get the regulatory and policy agenda joined up, and then I guess the last thing I was going to say was actually we've got to focus on how coming back to that point about the metrics moving in the wrong direction on the planetary level, is we've got to get we need to achieve, how does the finance and investment sector achieve real impact and real change? And actually a lot of sometimes we're overly mechanistic, so focusing on things like the kind of implied portfolio temperature metrics, and this is when you take a portfolio of stocks and you work out what's the temperature, what's the implied temperature from the companies in that portfolio. Simply by shifting which companies you're investing in doesn't clearly change the global emissions. So how do you link up investment with engagement? And it's really how the different parts of the economy work together. How do we get the finance investment sector working better with corporates and business? How do we get the right academic underpinnings for this? And how do we make sure that we're all working effectively with government, because we can't make this all work in a vacuum.
Right, so a lot still to do then. Nicola, not only is it temperature alignment and, net zero, there's other topics that are often not listened to enough around climate change, and I know that you've been working a lot on those. What are your reflections on where we're at the moment in terms of the strategies and how we might bring in some of the other topics like climate adaptation or biodiversity? I know that's been a big priority for the UK.
Thank you very much, Sophie. Well, I think perhaps am I the only scientist here? I think maybe, lovely. So, well, I think perhaps there's been an opportunity to just step back a little bit and think about what we're all trying to achieve here as well, and why finance is important. So perhaps I would speak to that and then come on to those broader issues. And those broader issues, I think, are incredibly important because everything is interconnected, and I don't think we realise that enough. So, coming back to this isn't your first rodeo comment. So I've been doing this for 20 years as a scientist, starting as a climate scientist in government on the Stern Review, starting in 2005. And from that perspective, I just want to, I know we all know this, but let's just recap on the urgency of the challenge that we're facing here. So in 2005, as the climate scientist on the steering group, my job was to look at emissions targets back in 2005. And we could see then, emissions were going up every year. They would need to peak around 2020 if we wanted to have any chance of bringing them down to avoid a catastrophic level of warming. It's now 17 years later, emissions are still ticking up and up and up and up. And we still are nowhere near peaking. And every year that goes by that we don't peak, the rate of emissions reductions after that peak to avoid catastrophic climate change increases significantly. So I think it's just important to recognise that scale of the challenge. And also in my career, I've worked in 2 areas that have been on the front line of climate change as well, that have given me a perspective on the scale of the challenge and the reality of this, because this isn't a future risk. I think when we sit in the UK, we often see it as something in the future. The two frontline areas I've worked in is in the insurance industry first. So the insurance industry, you can see losses from disasters ticking up every year, and you can now see them becoming systemic in their impacts. Systemic risk is not a future issue. We are seeing systemic risks emerging with increasing frequency already, and climate is already a driver of that, and biodiversity loss is a driver of that. So we're already seeing these risks now. The other area of frontline that I've worked on is in emerging and developing economies, most recently at the World Bank, also at DFID before that. Countries are experiencing these risks now, and in terms of emissions reductions, we're very focused on the UK, which is very important, but actually the UK has to play a role in supporting other countries in reducing their emissions, because there is absolutely no way that we can avoid dangerous climate change if we do not do that. Because most of the emissions will happen in emerging and developing economies. So that's the context, and 2 points on the positive side though. One, how important finance is. So in everything that I've seen, finance is critical in guiding how our economy will develop now and in the future. The decisions that are made today are going to lock in the structure of our economy for the next 30, 40, 50 years. So those decisions, it's absolutely urgent and critical that we bring climate into those decisions. Also, the leadership position that the UK has on this cannot be underestimated. What we're doing in the UK, our friends at Treasury, all of those around here, is really world leading. And I think we should be really proud of what we've achieved in the UK in terms of green finance. But there's a lot more to do. And I try and squeeze this down into 3 points, but I really struggled. I've got 4. This is too complex an issue for 3 points. But the first one is on the impact, so moving from disclosure and risk to impact. We've heard a lot about that. It was wonderful to see 130 billion in assets aligned with net zero as a commitment at Glasgow. How many of those banks and insurers actually knew what it would take to get to net zero at that time? Probably not many. So, we need to get real, and we need to get, credible plans short term. And we need to be monitoring that. We need to have a way to track, and we can't do this at the moment, track where finance is actually going. And is it really having an impact in terms of the sustainability goals that we want to see? The second point is real economy. This isn't just about finance. There's a triumvirate that we need to be working with here: finance, government, and the real economy. And we need work between government and the real economy as well. The Climate Change Committee published their progress report last week, showed that there were some key gaps that need to be filled in terms of the policy and regulation to guide the transition in the real economy. So I think finance is moving really fast, but we need that triumvirate to be working together. Third point, resilient transition. It's not all about net zero, and if we focus on net zero, we're going to see what we're seeing now, that whenever a big shock happens, we start reeling back on net zero. We need to think about how do we create a resilient transition as a society, and a resilient and inclusive transition, and we need to start baking that into the financial decisions that we're making. Third point is around a link to that. We've been so focused on the net zero, which is absolutely critical, but we also need to think about all the things that's interconnected with, or we will not manage these trade-offs explicitly, particularly when we start getting into difficult sectors like agriculture, for example, natural capital. We can't ignore the links between net zero, between resilience, between societies, and with nature. We have to start addressing that explicitly. And the role of developing countries as well, I think we need to start looking more at. So I would like to see the next green finance strategy really start to tackle these areas. And then finally is the public goods. So all of this has to be based on a good basis of knowledge, a basis of data, and we need open, credible data, open standards to enable us to do that. So continued investment in public goods is absolutely critical. So just to recap then, impact, real economy, resilient transition, beyond net zero, and public goods. I'll stop there.
Wow, lots of food for thought there. Thank you very much. Ian, can I just start by asking you a question about this ESG ratings hysteria that's going on at the moment? As somebody who's been in this space for a long time, do you feel that the quality of ESG ratings has changed, or that people care about ESG? What's driving the hysteria? Is it that people suddenly realise that ESG ratings are having an impact on their ability to do business, or is it that there's a decrease in the quality of ESG ratings, or an increase in the disparity between providers? Do you have a view on what's driving this pushback?
Yeah, sure. I think there's a fundamental lack of definition around what ESG actually means, and I don't think we'll ever find one, because I think ESG, almost by design, eludes definition. Environment, social factors are very hard to nail down, as the green taxonomy work is demonstrating. So I think 5 years ago there was a piece of analysis done to look at the ESG ratings of two well-known index providers for the same companies, and the R-squared was 0, so there was no correlation at all between data from two different providers. I'm not sure the situation's got any better, and I think the regulators, the SEC is probably in the vanguard here. Regulators are rightly pointing to issuers and financial institutions and calling out the need for transparency and consistency. So not demanding that there's a global definition for what ESG actually is, but if that phrase is used in financial statements, that it's described correctly, and when used in financial processes, for example, investment management processes, that it's thoughtfully and correctly applied. You give me a very narrow question. I've got my big speech.
No, well, it was just an aside. I'd like you then, please, if you were to talk a bit more about the strategies and your view as an investor about what a strategy needs to do.
Sure. Let me just make three brief overarching points. So I think the first point is we've come a long way. So my colleague Bruce Jenkins-Jones and I, Impacts, created one of the world's first green taxonomies back in 1999. So we've worked on that topic for nearly a quarter of a century. We've been working with financial institutions around the world for that length of time, since 1996, actually, so more than a quarter of a century. And today we're managing about $50 billion for pension funds from as far afield as Japan and Australia, and all the way through to California. So we're sort of in the trenches with live ammunition, which means that what we do actually matters when it comes to returns for clients, who ultimately are typically pension managers for millions of people around the world. So we've come a long way in the sense that the opportunities around sectoral and industrial transformation linked to clean energy, clean transportation, smarter infrastructure, low carbon food are really resonating with consumers, and as a result, regulators have got confidence to turn the ratchet to accelerate the deployment of these technologies through new industries. It's a very exciting time for consumers. At the same time, of course, financial institutions are aware to not just the risks of climate change, but also these new opportunities. So I think there's lots of reasons to be positive about the place that we're at today. However, second point, I think we're at a crossroads now. I think there are two ways we can go. We can think collectively as a global community around how to accelerate these market developments to rapidly move to clean electrification and clean transportation, and provide enormous wealth for people around the world in a way that helps us transition very rapidly to net zero. That is not a pipe dream. It's possible. The decline rates in cost prices of many of these industries is really phenomenal. And in that glass half full fork in the road, financial institutions would efficiently gather data around market opportunity, but also risk, and analyse it in a way which led to efficient capital allocation and effective and transparent disclosure to other stakeholders. And regulators would sort of facilitate the transition. The other fork in the road, which is the glass half empty, I'm mixing my metaphors on site, but that other fork in the road is, or journey we could take, is one of muddle, confusion, delay, and getting nowhere. And that's, of course, characterised by lack of communication of market opportunity and value add, and utility to consumers, poor information moving around the system, overly prescriptive and burdensome regulation that leads to red tape, cost, backlash, and ultimately voter rejection. And as a result, of course, then we don't have the transition. So therefore, the third point is that I think crucially this community has a good part of the answer to make sure that we go down the first of those two pathways and not the second. I think Ben's already touched on this because clearly the data and analytics community is right at the heart of the provision of correct, calibrated, timely, and complete information up and down the value chain. So it's a big topic. I'm sure this forum will get some way into discussing what's actually needed in terms of a blueprint. But I do think that this community should realise just how important it is in being able to help us to take the right path forward. So I'll stop there. I'm sure you've got other questions.
Thank you, Ian. I will be, by the way, taking questions from the audience towards the end of this, so please do start thinking if there's anything that you want to ask. Adam, lots of talk of taxonomies, lots of talk of EU stuff. Are there lessons to be learned? Are you allowed to talk about lessons to be learned? Because I have no doubt that you've been following this, particularly around kind of sequencing and standardisation between different initiatives. Have you any thoughts that you're allowed to say?
Sure. Yeah. Let me try and answer that, and I'll be careful. So, I mean, I think first of all we've been following the EU experience and approach on sustainable finance really carefully. Obviously, the UK was a member state and was part of the process that developed, for example, the Sustainable Finance Action Plan. The EU Green Taxonomy was developed in large part whilst the UK was a member state. So we've been watching that carefully. In terms of our own policies, we onshored the EU taxonomy framework, so the level 1 law, which essentially means that our taxonomy structurally is very similar to the EU. We didn't do the same thing on the disclosures legislation. So the EU has SFDR, CSRD, and we didn't onshore that in the UK. So functionally, that means we are building and designing our own framework there. In terms of lessons to be learned from the EU, I think I'd point to a few things. I mean, first, it's important to say that the EU has been really groundbreaking. You know, they've pushed ahead and they've done some of the work through the Sustainable Finance Action Plan, really kind of moved forward the debate globally, I think. But, you know, in our assessment of the EU approach on sustainable finance, I'd say that we've listened very carefully in the UK to business, to industry, in terms of how we should implement our own approach. And in particular, you mentioned sequencing. I think for us, we, on disclosures, for example, we are implementing a whole economy disclosure requirement regime, which will apply both to real economy and to financial services firms, which means there's not really fragmentation between those two elements. And it also allows us to then think very carefully about sequencing. So, for example, in the Greening Finance Roadmap, we made a clear commitment that we would implement disclosures for corporates on key areas before it would apply to asset managers in the financial services sector. And we think that's really important, as you mentioned, to ensure that the information can flow through the economy so that asset managers have the information from the corporates that they invest in. So I'd point to that as something where I think we've maybe learned from the EU experience.
Anyone who has managed to dodge the EU stuff, they ask the asset managers to do the disclosures before they ask the companies to do the disclosures. So it caused a bit of chaos for a little bit while things bedded down. So that's the context to that, I think. Sorry, carry on.
I mean, just lastly, I'd say on the taxonomy approach, we've also been following the EU debate on that really clearly. And I think there are some elements in the UK that make it maybe a bit easier for us. One is that because we don't have 27 countries that we're trying to bring together, we're just working in the UK, we can look at what is the UK's transition pathway. And I think in that we have sort of clearer and more settled policy in some areas.
Does anyone else on the panel want to, David?
Yeah, maybe I can just build on some of that. I think, and maybe also what Nikki said earlier as well, the UK has played such an important role in creating frameworks that then get replicated in other markets around the world. And so we've seen that with things like the Corporate Governance Code, we've seen it things with the Stewardship Code. UK was the first to introduce climate reporting on companies, on the changes to pensions and the Statement of Investment Principles, incorporating climate and ESG. These are all things that started here and then have been replicated in market after market. And so, I mean, as Adam says, the EU has had incredible ambition and has moved incredibly fast, which is excellent. Although what we've seen is that sometimes it is overly prescriptive, sometimes it's not very well joined up, or it's almost too ambitious and trying to do too many things within the same piece of disclosure legislation. Things like with the taxonomy work, which should be very clear and simple around solution products and services, but with a number of the well-intentioned additional elements, do no significant harm, social safeguards, it creates something which is very complex for the market to implement. And so what is really exciting about the UK is we're looking to try and kind of achieve a level of consistency with the EU, but also trying to address some of those barriers to kind of wide-scale adoption and for it to be able to be implemented more easily. So, what we're hoping to see with this next, with the next Green Finance Strategy 2.0 is partly kind of now we've got the kind of underpinnings coming together with the UK taxonomy work, the sustainability disclosure piece, as well as the transition plan task force. But we now need to see the kind of pace of implementation, because if the UK can then start to help set the standards, we need to see that being moved into implementation quite quickly. A piece which connects with the taxonomy actually is mandatory green revenues disclosure, so disclosing revenues associated with those solution products and services. A lot of investors wanting to allocate to green industries, but in a similar way, companies not breaking out their revenue from green products and services. We need to see this not just apply to publicly listed companies, but to private companies. We need this kind of economy-wide, and sometimes that's could be lacking. And then, and also this ability to be able to kind of help the UK can hope if we can play that role, helping join up what's happening globally and align ourselves with international standards. That is incredibly powerful and can really help provide that consistency, which enables kind of large-scale investor and finance action.
Ian, and then Chris, could you come in on that, please?
Yeah, so I think we're seeing a worrying divergence in regulations in this space. I think the EU is going down an overly prescriptive route that's leading to market practitioners having to employ a lot more people just to comply, with no obvious benefit to the end customer, who's ultimately a saver or a pension holder. The other direction is what the SEC is doing, which is, as I mentioned, around transparency and disclosure without any prescription as to what the underlying is. I think the UK's got an opportunity to try and sort of bring these two together by showing a sort of sensible middle ground. But I would like to see that the Green Finance Strategy 2.0 moves also in the direction of supporting new markets. I think this idea of financing green is at a critical juncture. We've done the easy stuff. We've now got to do the hard stuff. There are a number of hard-to-address sectors, so not just steel and cement, which would be hard to abate, but hard to address being buildings energy efficiency in particular, where we don't have the solutions. So I'd really like to see the 2.0 GFS focus on that. And I think there's a huge opportunity in market-based solutions around natural capital, and I think we've seen some encouraging progress around creation of fungible credits for peatland restoration. So more work could be done to really sort of put the regulator behind, in principle, the creation of these new structures and incorporating them into carbon markets, not just in the UK, but ultimately internationally. And I think just to sort of re-emphasise this point about international collaboration, I think that the UK, as a global financial centre, does have huge convening power. So we need to find a way to ensure that the UK listing rules remain competitive globally. And I think the Green Finance Strategy can point to that as an important area for further work.
And just to pick up on a couple of points that were made before. So in order to have a smooth and effective transition, it needs to be a whole economy transition. You need to go deep into the real economy. And to do that, the outputs for the Green Finance Strategy, I think, need to bind to as great a proportion of real economy and financial firms as possible. But there is a proportionality point. This is really, really expensive, and there's a question on how quickly the smaller institutions can be asked to gather data, disclose upon data, think about how the opportunities and risks are going to impact their institutions. So in light of that, I think there will always be a temptation to give a little bit more time to the smaller firms to adapt and to be caught by these regulations. But there's a trade-off here. The longer you give them, the longer it will be until we have the data that we need to understand what's going on in those sectors, and the longer it will take for those institutions to actually understand their role in the transition. And eventually that could lead to more costs as well for the smaller institutions. So I think one of the really interesting discussions that we're seeing both domestically and internationally is how deep into the economy do you go with these requirements? And also, when you do go deep into the economy, how binding are those requirements? How ambitious are those requirements? If you're asking firms to think about their future paths, what does a scenario analysis look like for a smaller firm versus a larger firm? And I think this is something that is going to be really key as we go forward. And I know it's a big discussion internationally. And the other side of proportionality is that point on prescription. So in the EU, we have seen incredibly detailed requirements to firms. And I think watching how that rolls out over there will be really important. And we've got the benefit of being able to see how that works, because there's definitely pros and cons to asking institutions to collect very, very granular data. But one of the things that we need to avoid, whatever happens, is doing something that's totally different in different regions around the world, because that comes with huge costs to those industries that are in many different geographies, and it means you can't compare things. And ultimately, that's what we want to do. We want to have data across the economy that is comparable. So I think we're in a really key juncture as we go into this second phase of the GFS, which is an opportunity as well as a challenge.
Thank you. Nicola, did you have anything you wanted to
Well, maybe just a final point on this tension between the urgency of the problem and all of the huge requirements that we are putting onto the financial sector at the moment. And so I talk to a lot of financial institutions in the context of my role at CGFI. And one of the things that we do here is a huge eagerness to really do their part on this. There is a real buy-in to the challenge and also to the opportunities. Let's be frank as well. We're putting this is the biggest investment opportunity in hundreds of years. So this is a massive opportunity. But at the same time, this tension of we want to, but this is really hard. What we're asking people to do, incredibly difficult. And I was up in Edinburgh a couple of weeks ago talking to pensions trustees, for example, having to get their head round, they have no background in this, get their head around all of these complex indicators that they've never thought of before in a very short time, is very, very tough. But I think, so we do need to be cautious about that, and I completely agree on the smaller firms as well, and also the challenges there that actually if we don't engage the smaller firms, they could be crowded out in some ways from the opportunities. But one example I wanted to give is actually from the Bank of England's work on the recent climate stress test. And that one of the things, so we're doing a consultation with banks and insurers that participate in that at the moment to understand what they learned from it. And when we first spoke to them over a year ago, there was sort of, I wouldn't say panic, maybe that's too strong a word, but a lot of how on earth are we going to do this? Whereas now, the level of capacity that's been built over the last year is incredible. And that, the number of young experts in this area that have gone into the banking sector, for example. I talk to banks that are now, able to talk about, flood risk and windstorm risk in the UK and supply chain risk that were never able to talk about that before. So that, you know, all of them have been extremely positive about the process in terms of supporting them to build their own capability. So I think it's hard what we're asking them to do, but actually I think, you know, if we can support firms well to do this, I think it, you know, the benefits will be huge. And actually positioning the UK as well as a real leader on this, if we can do this, you know, we can be a real leader. But just as a final point, to do that, I don't think we have to match what we're putting on the financial sector with what we're doing with the real economy to support the real economy transition and public goods, you know, all of the data, the training that we need. We can't do this without that foundational level of support to enable this transition.
Thank you. Does anyone have any questions that they would like to ask in the audience? I've got lots more I'd like to ask, but I don't want to be greedy, so if anyone's got anything. Right, at the back there, I don't know if there's any mics. Ben, are there any mics, or can you, it's quite a small room, you can probably holler if there aren't.
Sure. My name is Jimmy, and I'm with the Smith School over at Harvard University. And Chris, I love what you said about comparability and non-comparability. And I was wondering, David, given earlier you were talking about how some of these modeling errors might be 100 to 200% off, how you're starting to try to grapple with the comparability issues that are coming up through ESG metrics.
So, I mean, it's very difficult. So, I mean, we need more real, hard data. And I think, you know, and it also requires more transparency and openness about where we've got these data gaps. Now, this is not an excuse for inaction, but it does make action much more inefficient when you don't have the right underpinnings. So, hence why, I mean, you know, we're now kind of calling for, you know, mandatory, you know, climate reporting, green revenues, transition plans from every government around the world. Is certainly our position, and we'd like others to do the same and to work together to try and get some of that. Now, there could be technology answers here as well. If we can start getting more asset level information, not necessarily from corporate reported sources, but from other sources, and you can start to then link together alternative ways of being able to calculate this and then test it against what is or isn't being reported, that can help. But this also takes a lot of time. So I think more transparency, more openness and more frank discussions about these problems is really important.
Ian, do you want to?
Yeah, I think it's very important to move from the generic to the specific here, because we're talking about a very wide range of different issues. And so I really commend the CGFI's flagship programs. Impacts is working on the physical climate risk side, one of the asset managers. And what we're trying to do there is work out what are the questions that we should be asking our investee companies to report on, and assessing the data that's coming back so that we can work out for that specific use case, if you like, whether there's a missing piece in the, if you like, research community. So really encourage you all, I'm sure you're all involved already with CGFI, to get your sleeves rolled up and working on these use cases, because it's only by tackling specific problems and trying to work them through all the way through to the output, the sort of final report, that we'll see where the gaps are.
And just very quickly on that, so I'm going to go from the specific to the generic, I'm afraid. But in the absence of data, it's very important that firms use their judgment or the best proxy for data that they've got. Because in the absence of doing that, you've just got a gap and you don't have any analysis. We can learn by doing that, but I think it's really important that firms expose their judgments and explain how they're thinking about filling those gaps. And sometimes it will be, you know, good, and sometimes it will be bad. When we ran our scenario exercise, we didn't form a view on which of the firms had done a worse or not a judgment. We kept the results as they were in what we published. But what we did observe was some better practices, and we'll be feeding those back to institutions so we can learn by doing. But I do think there's going to be a process of learning while doing, whilst we were making those big steps.
Adam, just quickly, the role of we're very reliant on corporates disclosing their own data here, and obviously there are providers that estimate and stuff as well, but what about things like asset level data that's been done by academics and institutions. Is there a role, is the ultimate goal that these companies will disclose all this information themselves, or is your vision for disclosure that there will be other sources of this information that will fill those gaps?
Yeah, I think what we want to do is get the data ecosystem working functionally, and I think corporate disclosures play a really important role on that. I think for various reasons they're typically, more accurate, more comparable. However, the ESG data providers, ratings agencies are playing a really important role in that ecosystem for firms, for investor decision making. I think as government, we're not wanting to get involved in that. It's really up to firms to decide how they make investment decisions, what data providers they use and what data they use. But I think what we want to do is make sure that you have a baseline of corporate disclosures, which as far as possible is internationally comparable around the world, so that companies in jurisdictions all around the world are all reporting consistent and comparable data.
Okay, so that's the key. The gentleman at the front here.
Andrew Ross from Local Garden. It's a question for Alex. The Levelling Up and Regeneration Bill is going through Parliament at the moment, and local authorities are required to follow the 25-year environment plan and deliver net zero. But they don't seem to be required to be doing this using green finance. They have to report directly to HM Treasury. Couldn't HM Treasury ask them to do it with green finance?
Tricky question. Are you allowed to answer that? Probably.
I have to say, I'm not sure I fully understand the question. I think, in general for us, we think there are green finance, sustainable finance is really important. So what my team does is specifically working with the financial services sector and thinking about what is an appropriate regulatory regime for the financial services sector relating to green finance. So we certainly don't cover everything relating to, for example, how do we fund net zero, what private finance do we need. But I think in terms of the financial services sector, I think as Chris says, it's an important component, but there are also limits. This needs to be a whole economy transition. And so the architecture and the ecosystem that we're putting in place for the financial services sector is just kind of one piece of that broader puzzle. I'm not sure that really exactly answered your question.
Are you talking about local authorities issuing green bonds? And that's not your remit to tell local authorities to issue green bonds, I'm guessing, but it is something that...
It's also not really so in terms of local government finance, I would say that's not really certainly not my area, but it's a question for local authorities, not so much for the Treasury centrally, I'd say.
Okay. We've got time for one more question, and I'd like it to be from a woman, if we can, please. This lady here, if you don't mind.
Hi, I'm Roland Asset Management.
There's a mic just coming to you now.
Hi, it's Manetta Spamieri from Royal London Asset Management. I just wanted to challenge the assumption that with better data and disclosures we would get better decisions, and ask what finance or what the regulators can do on the green finance strategy to incentivize better decisions in the financial industry.
Does anyone want to pick that up? That's a big question.
I'll go at that. So it's always good to be challenged. So the Bank of England's done its own disclosure document for the last 3 years. The process of doing that document in itself was incredibly useful. It focused people's minds across the organisation. It made us understand risks in our organisation in a way that we never did. And frankly, it's helped us to shape the strategy for how we manage our own risks within our organisation. So I think the process of disclosure is useful for external observers looking into an institution, but actually internally it is a hugely, hugely valuable process. And actually I think that's one of the things that's often overlooked when we talk about disclosure. But you're right, disclosure and some of the data that comes from it is not a silver bullet. It's not going to solve all the issues. The kinds of data that you include in disclosure are not often the kinds of data that you need for modelling and to understand the risks. So I think sometimes it is too usually used as a proxy, as an issue solver. But I do think it is an important first step to get that in place to allow it to create the right investment and the understanding within firms. But I think it's going to be many, many years until we have all the data that we need.
So is this an issue? So as a journalist who's been writing about this stuff for quite a long time now, there's a recent phenomenon of market participants saying that they can't really engage in a conversation about how they do transactions differently or how they allocate capital differently, because now they have to conquer the data first, and then once they've done the data in whatever initiative it is, then they'll be ready to assess how they do things differently. But actually that can often mean that they're talking about 2 or 3 years down the line before they have a serious conversation about the way that they're allocating capital, the kind of transactions that they do. Is there a worry that if we overemphasize data, we're kind of giving an excuse or a distraction to these institutions to not deal with things which quite obviously need dealing with now and can be dealt with now? You're nodding, Ian. Do you...
No, I think it's a critical question. I'm really glad this came up as a sort of the crux of the whole debate, because there's a real risk, per my sort of fork in the road, that we go down the path in which there's just a request from regulators for disclosure backed by data which is expensive to collect without a real analysis of what the purpose is, what the decision that will be informed by the disclosure of the data. So what we need in the Green Finance Strategy 2.0 is a critical assessment, point by point, of any further disclosure requirements to tie them back to the analysis of risk and opportunity that companies are already mandated to disclose under the Companies Act and under the listing rules. The environmental issues do raise the bar and throw in new challenges, but we've got a couple of centuries of experience of doing this. It works pretty well. We just need to adapt it to fit the new paradigm of environmental change, climate change, rather than just throw the kitchen sink at this problem. And I think that sort of brings us back to the critical role of this community and CGFI, is focusing on user needs, theories of change, not just looking at data, but looking at the analytics to work out what models will produce outputs that inform decisions that are useful, and then look for the data to support them. So we've got to get the priorities right, otherwise we'll end up with a huge amount of red tape, which in a few years' time will end up being unwound by some future government that looks at it as an unnecessary burden for private sector.
Can I add
Yeah, absolutely.
two brief points? So one, the first is on the importance of transition plans, with another type of data and disclosure requirement. But why that is so important is because the disclosures right now are basically based on what companies are doing now and the risk faced now. Actually, that's not what is fundamentally important in terms of the transition. It is, how is that company going to change over time? What is it going to do to support the transition, and to what extent is that aligned with our goal as a society in the UK or elsewhere? And at the moment, we just don't have that information. And that's one of the things that we hear a lot from financial institutions and also, corporates and others, that actually having that information, if you're a financial institution, it's very difficult to even know where to invest right now. How do you compare two companies? Who has the plan that's moving in the right direction? So I think that's a really critical gap, and I'm very pleased that in the UK we're making so much progress on that. And the second challenge that we hear a lot from financial institutions is just having good things to invest in. The types of new technologies that we need to create this transition. And again, this comes back to the link between the real economy, government, and the financial sector. We need those new technologies, and we need many things to happen in order for them to become investable. This pipeline of investable projects. And I think that's has to be a key focus as well. If you're looking at, our current plans at the moment are very dependent on a future hydrogen economy. In the UK, we need investment in that area. We need investable projects. So that's another key gap that needs to be filled.
Fantastic, thank you. David, just quickly before I wrap up.
But so I think, as I said earlier, the challenges around data quality can't be an excuse for inaction. In fact, and we're seeing people move, which is great. But it's not just about improved financial decisions. It's also about then how does that actually result in the real world impact. And that's where the changes in investment flow needs to be linked to the corporate engagement piece. So you need this understanding between investors and companies and providers of finance, so that as companies improve, they will get better access to capital. And if they're not aligned with net zero and climate transition, then they're going to start to have capital restricted. And one of the most exciting things I've seen on the index side has been where we've been using like, data from the TPI, the Transition Pathway Initiative, and the Climate Action 100+, so that basically as companies improve on what they're being asked to by the engagement teams, then their weight in the portfolios and the index trackers goes up. So you get the investment in capital flows follow the engagement ask. And if they go in the wrong direction, then the investment gets pulled away. But we need to find those mechanisms that connect up that engagement and the investment in finance flows to make it work. And also make sure we're linking it all with great academic science and making sure we've got that robustness. And that's bringing it back to CGFI. I think one of the importance of here is making sure that with the fantastic academic underpinnings we've got in the UK, the university excellence, how we can be using that with the business and finance community.
No pressure, Adam, but this is what apparently this next sustainable finance strategy needs to cover. So what I've got from the conversation, amazing conversation today, is moving from informing to acting. Better quality data will allow financial institutions to act, and forward-looking data is also important, but we need to move past the data and have a conversation about developing markets, about biodiversity, about adaptation, all the other parts that satellite net zero, create a pipeline of investments so that we can actually start moving things into the real economy, and doing that partly by addressing the hard to address thus far sectors, and create those pipelines around things like insulation and offsets, and well, actually I shouldn't say offsets, carbon markets. Really importantly, bringing on the SMEs in a way that we can get buy-in from them, but without overburdening them with regulation and reporting standards, and linking data and products to engagement and all of the stewardship work that's going on in the market. Easy, right? All that's left for me to do then, I think, because we're running out of time, is to say thank you to our wonderful panellists for that very informative discussion, and we'll see you all.